Welcome to our FI journey. Did you know that in Canada, we can turn our mortgage into a tax deduction at the end of the year? Stick around and we'll let you know how to go about doing it.
Hello, we are so grateful to have you with us today. My name is Jean.
And I'm Christine.
And we are Fire Go. Welcome to our FI journey. So this is the channel where we share with you our journey to financial independence. Actually, our journey started back in 2019 where we had around $60,000 in consumer debt. Thank God this is actually over and we are now on our way to become financially independent and retire early in 2024. Thanks for the opportunity. We hope you enjoyed this video, and as Christine has mentioned before, we will be discussing today one strategy that we are using in our FI journey. But before going there are a few housekeeping items that I wanted to share with you. First of all, this is not gonna be a sponsored video. It's only our own experience and how we are doing this with our mortgage. So we have a mortgage here and we live in Toronto, Canada. The second one, we are not financial advisors, and it's really important that you do your own research, and you talk with somebody and see what it works for you or not. In our situation, we do have an accountant and we also have a financial advisor which is helping us going through our FI journey. So this is just another idea that you might pursue in your FI journey. Having said that, enough talking, so let's discuss the topic today.
So we're going to break the video down into 4 separate areas. It's just there's a lot of information, so I think it's going to be more helpful if we break it down into 4 sections. So the first section is going to be
it's actually what is the Smith Manoeuvre, so where we are going to discuss about this technique that we are using right now. The second one,
it's going to be the 6 steps that we've kind of taken in our own journey in order to prepare ourselves and get ready in order to implement this strategy.
Yeah, we are trying to summarize as much as possible within this video, so there's a lot to cover, but either way, the part number 3, we will show you like a visual representation, like from the end-to-end process on how it works.
Yeah, and then last but not least, part 4 is just going to be some pros and cons that we've kind of come up with and that we weighed in order to decide whether this was something that we wanted to pursue or not.
Yeah, exactly. And having said that, use the chapters below if you want to. You can navigate through and skip some of these sections. We do recommend that you kind of go along with us, and then as we explain what it works and how we are doing, I hope that is going to be beneficial to you. Enough talking, should we start?
Let's go.
Yeah. Let's start with part number 1. What we are basically doing is we are borrowing money from our house here to invest. So this is actually a technique that here in Canada you might have heard of. It is actually the Smith Manoeuvre, right?
Yeah, it was coined several decades ago by Fraser Smith. He lives in BC. He was a financial advisor, and he came up with this strategy for Canadians in order for us to be able to start getting a tax deduction from our mortgages, which is our largest debt here in Canada. I believe our friends south of the border actually get to deduct the interest that they pay off of their mortgage. Here in Canada, we can't. If it's our principal residence, then the interest that we pay is not tax deductible.
So that's why Fraser Smith, he had a lot of time and he decided to read the Tax Act and reading that information, so he came up with, this strategy.
So this is actually embedded in Canadian tax law, and I'm not going to read it to you. You guys can read it on the screen, but broken down in layman's terms, basically, the government says that if you're going to borrow money to invest with the reasonable expectation of earning an income from that money, whether it's into the stock market, if you're buying real estate for investment purposes, if that's the case, if you're borrowing this money, then any interest that you incur on that money is now a tax deduction at the end of the year.
Yeah. Something else is if you are trying to do this to buy a car, to buy a bike, to go on a trip, this is not what you should do.
No, you have to be able to generate income, right? So yeah, it needs to be something that's going to pay you.
Exactly.
So in part number 2, we're going to talk about the 6 steps that Jean and I took in order to sort of get ready and get prepared in order to implement this particular strategy in our FI journey.
Yeah.
So step number 1.
You need, of course, to have a mortgage, and the mortgage that you have, it should be or a readvanceable line of credit. It could not be any kind of line of credit. So it must be a readvanceable line of credit.
Yeah, and basically what that means is whatever you pay in the principal is going to pop over to your line of credit. So it readvances the funds that you've paid down onto your line of credit.
Yeah. Step number 2, you need to open a non-registered account.
Yeah, non-registered. So this will not work with a TFSA. It will not work with an RRSP, RESP. It needs to be a non-registered account. That goes back to the tax law where you're going to be generating income. You have to be expecting to generate income. If you're generating income, what does that mean? The government wants their cut. So inside of tax sheltered accounts, this won't work. It doesn't qualify. It needs to be done within a non-registered account so that at the end of the year, whatever you've made in capital gains or dividends, the government wants their cut. They want to get paid.
Yeah, and step number 3 though, speaking of the government that wants that cut, it's really important that you do have a bank account where you are going to be using strictly to do, like all the operations. So meaning, transfer money to your home line of credit, to your brokers, or so on and so forth. So it's really important that you use this account only for that.
Yeah, so in our case, we have one bank account that's strictly for money that comes off of our HELOC and into our investment account. That's the only thing that this bank account does. And in doing that, we've allowed ourselves a very easy way to track all of the money that we're taking from our home equity line of credit and putting into our investments, whether that's some real estate investments or into our dividend investments. That way, when the Canadian government, when the CRA comes knocking at the end of the year and they say, we want to see the trail of all this money that now you're claiming the interest on, we're able to then go through and show them exactly what money we've withdrawn, what interest we're talking about claiming, and then they're happy, it's satisfied.
Yes. Number 4, so step number 4, in our case, what we are doing is we are using this money to invest. So we are basically investing in Canadian dividend-paying stocks. And the reason that we are using the Canadian dividend-paying stocks is because of the tax treatment that you have, which is actually in our favor.
Yeah, we won't get into that now. But by sticking with Canadian stocks, we're getting a really good deal on the tax that we have to pay at the end of the year.
Yeah. Step number 5?
Step number 5 is making sure that each time we make those mortgage payments against our principal, that principal amount that flows back over onto the HELOC, we're immediately taking that off and reinvesting it into our investments. Every 2 weeks. We do bi-weekly payments, but if it's a monthly payment that you're making or bi-weekly, every time that little amount pops back up on your HELOC, you need to make sure you're taking it off and reinvesting it back into your investments. And step number 6 is?
I don't know. Let's look at my paper. But basically, once you receive dividends or rent, what do you do?
You take that money. So in our case, we're receiving dividends from the Canadian dividend stocks that we hold inside our non-registered account. Once we receive those dividends, we withdraw them because now they're income on our statement anyways. We withdraw them. We cycle them back through our mortgage as an extra payment that we're putting down on the mortgage, which flows through back onto our home equity line of credit in full, because this is a regular, it's not a regular mortgage payment. This is an extra payment that we're making. Mm-hmm. It flows through onto the HELOC in full, and then we reinvest that. So we grab that money back off the HELOC, put it back through into our non-registered account, and reinvest that back into more of the Canadian dividend-paying stocks.
Now let's talk about part number 3. As you can see, there's a lot of information going on, and being a visual person myself, I always try to see, things with graphics, like of having a visual representation, which it makes more sense, at least to me, and I hope it does to you as well. Let's use an example. Let's pretend that you do have a mortgage, and it's a mortgage of $500,000. As we have mentioned before, it's gotta be a readvanceable mortgage. Every month or every 2 weeks or whatever the frequency that you have, you make a payment. This example, we have a payment of $2,000. So based on this $2,000, $1,500 it goes to the interest that you pay, and $500 goes to your principal.
Exactly. And so because that $500 goes to the principal, the home equity line of credit that was originally at 0, that $500 flows over to the home equity line of credit, and now you have available to you on your home equity line of credit $500.
Yeah.
That's the $500 you're now going to withdraw, move through that specific bank account, and put it, in our case, we put it into our non-registered investment account, where we ourselves are purchasing Canadian dividend-paying stocks.
As you keep doing this month over month, your mortgage is actually decreasing, but at the same time, your HELOC is increasing. So the amount that you have in your HELOC, you are transferring this money to your bank account, to that specific bank account for the CRA, so you can track everything. After you have the money in your bank account, you transfer over to your brokerage, and you do this over and over and over.
Mm-hmm.
Right?
That's where the debt conversion's coming in, right?
Yes.
You're converting it from your mortgage, your traditional mortgage, into more of an investment loan, basically, is what you're doing.
Yes.
Long and short. And then eventually, all of those investments that you've made inside your margin account, let's say they generate $100 in dividend payments. This is where we're talking now. We're going to withdraw this $100 in dividend payments that we've received, put it directly onto our mortgage as an added payment. Because it's not our regular payment, that $100 is going to flow directly to the HELOC in full, so we don't have to worry about any of it going to interest. Mm-hmm. Once it shows up on the HELOC, we're going to re-withdraw that $100 and again put it right back into the non-registered account, the margin account.
Yes.
And we keep doing it over and over and over.
Yeah.
And that's basically what, I mean, there is a lot to it, and that's pretty basic. And obviously, if you want more information, there's tons of resources out there.
Yeah.
Including the book. I don't even know if we have it here, but there's an actual book that we're going to link down below or up above somewhere. There's a link for the Smith Manoeuvre book. Highly recommend it. It's a great read. And it really opens your eyes to some interesting possibilities.
Now let's look at the pros and cons of using this strategy.
So one of the pros, obviously, is that you're going to build up quite a substantial investment portfolio. Now, whether that's in stocks, dividend-paying stocks, ETFs, or real estate, depending on what you choose to invest in. Another pro is that at the end of the year, because you're now borrowing all this money to invest with the reasonable expectation of earning income, all of the interest, yes, the HELOC is going to generate interest that you have to pay. All of that interest is now a tax deduction. So yes, you've added income through dividends or capital gains, but now you're receiving quite a good tax deduction based on the interest that you've paid in order to make that money.
Yeah, and going with this example, even the tax refund that you get, you can put this tax refund going through your mortgage, so you're gonna circle through, and that's basically what we have to do in our case.
Pay it down faster and faster. The non-deductible, obviously it's converting, so it's just going to the other side. But then all that interest that you were once not being able to deduct is now a deduction in your favor.
Yeah.
But there's cons.
Yeah, quite a few. And the first one is actually you are leveraging money. So as a result, you need to be comfortable with the leverage investing and making sure that you can't sleep in the night. Mm-hmm. If you don't think that is going to be the case, if you keep looking at your stocks or whatever strategy that you are using for, so this is something that you need to be comfortable with. In our case, we are. Mm-hmm. Even though sometimes...
Oh, don't get us wrong. Like, we check the stock market all the time.
I would say every day.
But we're comfortable, and we realize that there's going to be good and bad days, and we're just going to ride it out.
Yes.
Yep.
What is another con that we have?
Whether it's a con or not, one of the other cons we have listed is record keeping. It's going to be a task that needs to be done very regularly and on a consistent basis, so that if the CRA wants to see where your money has gone, why you're claiming all of this interest now as a deduction, you're going to be able to show them directly how the money has gone and the total amounts that you've invested.
This is a really good point, and we do ourselves, and as we have mentioned, we also have an accountant who help us with our taxes at the end of the year. So we wanted to make sure that this is actually correct. So every single month we sit together, we go through our finances and budget and all of that stuff, and on top of that we still do the record keeping for for the stocks and what we have bought or not.
Mm-hmm. And the last con that we came up with is, it's great, we're going to be able to use all of this interest as a tax deduction, but in order to generate that tax deduction, we have to generate extra income. So we're adding more income on top of our regular day-to-day income. So we actually have to pay more tax at the end of the year. It gets offset with the deductions and whatnot, but you have to recognize that you're going to be paying more tax on your dividends, capital gains, or real estate investments. So those are the 4 areas that we wanted to talk about with regards to investing, borrowing money to invest, or the Smith Maneuver. We hope you guys found it helpful. It's a lot of information. We just did bare bones. We could spend probably hours getting into all the different intricacies of it.
Yes.
And we don't even know them all, to be completely honest. We're still learning as we go to a certain extent as well.
Yeah, that's really important, and there are a few resources available to you, and the first one that we did use was actually the book. I'm gonna link on the description below that you can take a look. Another one is a blog here in Canada which is called The $1 Million Journey. There you can see it's a great resource that you can go and take a look. There's a lot of people trying to do and understand, and the community is quite helpful. You also have the Red Flag Deals, which is a forum here for usually in Canada. So there's a topic related to the Smith Maneuver, and not only on Red Flag Deals, and even on Reddit. All the links are available to you. Feel free to go and click them through and learn more about the Smith Maneuver.
Yeah, just take everything with a grain of salt. If you have any questions, obviously ask your tax, like your accountants, your financial planners. Reach out to the people at the Smith Maneuver. I'm sure they'd be more than happy to answer your questions as well.
Yeah, and keep learning, and that's what we are still doing. We have been just over 1 year with the Smith Maneuver since we just started. We are planning to maybe release a few videos about the strategy and what we are investing in or not. If this is something that you might find helpful, let us know in the comments, and we'll definitely include these videos in the future.
Yeah. So thanks for sticking around. We hope you learned something, and we'll see you next week.
Yeah, thanks for your time. We appreciate it. We are very grateful to have you with us today. Stay well, stay safe, and we'll see you in our next video.
Take care.
Bye. This anymore.
Okay. Welcome to our...
Sorry, I was just putting my... Okay, now I'm good.
You sure?
Yes.
Okay. Welcome to our FI journey. Okay. Welcome to our FI journey.
This is our... Hey, yeah.
And in that non-rest...
But I couldn't.
Okay.
All right.